Hi, everyone. Welcome. Thanks for joining us today. My name is Rupi Chima. I'm the managing partner of EB5 Energy. And I have with me our CEO, Mark Wagner. So today we are going to make a side presentation, and then I'll play a little video, and then Mark will discuss the more technical aspect of the project with you. Just a little background on me. I've been in the EB5 industry since about 2012, doing due diligence on EB5 projects. And during that time, I looked at hundreds of offerings. So I'm very familiar with how they're structured and some of the pitfalls. So when the new rules were introduced in 2022, I wanted to offer a better opportunity to investors with better terms. And that's when I decided that oil and gas was a perfect fit for the new rules, because the new rules offered two big benefits to investors. One was, by investing in a rural area, you have priority processing and a 20% visa set aside. And secondly, you only had to have your investment locked in for 2 years. And to me, the oil and gas sector, it really fits that perfectly to deliver on those two benefits. So I think when the rural set aside was introduced, it didn't make a lot of the real estate players happy, because now they had to go find real estate projects in rural markets, which is limiting because you are limited to developments that are more second homes, vacation homes, or hospitality that's tied to tourism. So it's not like having a multi-family project in New York or Miami. So it limits the type of real estate projects that are available in rural markets. So today I want to talk about why we feel that we are a much better choice than a real estate project. And I'm going to share my screen and start the slideshow. You may have heard from real estate projects that oil and gas is not as safe as a real estate project. And we are a much safer opportunity. And I say that because of all the terms that we offer to EB5 investors. One is that investors get a first position on all of our cash flow. So they're first in line to get their capital back before any profits are distributed to anybody, to management or operators or even investors. We offer a shorter repayment timeline than your typical real estate project. We have a target repayment of 3 years, and compare that with a loan term of 4 to 5 years with 2 extensions. Effectively, it's a term of 5 to 7 years where your money is locked in for 5 to 7 years. And the oil and gas sector is also very lucrative. We have very good profit margins. At current prices, we have 100% profit margins. That provides a lot of cushion to investors. And often in real estate, developers are working with single-digit margins. We're one of the only projects that is providing an opportunity to share in the upside. So our project offers 35% of the profits to EB5 investors after they get their money back. Compare that to 0.5% or 1% preferred return, and it's capped at that, no matter what the EB5 fund makes, no matter what the developer makes. We are a better opportunity because of the way the deal is structured. Typically in real estate, you're investing in a new commercial enterprise as a limited partner, and the new commercial enterprise is in the business of lending money. It doesn't have any tangible assets. It's taking money from EB5 investors and then making a loan to a developer who owns all of the assets. So the NCE, the new commercial enterprise, is holding a financial instrument. But you're not getting paid market rates for that loan, but you're sitting in the riskiest position because you're behind the senior loan, you're behind any bridge loans. The senior loan has a first priority lien on all the assets. It's going to get repaid no matter what, but the EB5 loan is usually subordinated to all of the other debt. So it's essentially an unsecured loan. You may have a pledge of the developer's ownership into the project. But if there is any kind of a failure, that pledge usually becomes worthless because there isn't much left. After the secured debt takes all the funds, there isn't much left for unsecured debt. Whereas with us, we are structured like a private equity fund where the EB5 investors invest into the new commercial enterprise, and that new commercial enterprise invests money into the job creating entity. So it owns the project through the job creating entity. The job creating entity owns all of the assets, and therefore the investors own the assets. So there is no other third party to pursue. There's nobody else that owns this project. We as management and operators, our job is to manage your money, execute on the business plan, and then we get to participate in profits after we have repaid your capital. So that's the big difference. You are the owners of this project and you're first in line to get your money back. Another big difference between real estate projects and our oil and gas project is the timeline. Construction projects can last 3-4 years. It's a long construction timeline, which introduces a lot of risk. For example, a lot can happen in those 3-4 years, potentially changes to budget, costs can increase, market changes. There could be unforeseen circumstances that delay the project. So the construction timeline introduces a risk, whereas for one oil and gas well, it takes us less than 30 days to drill. And that is followed by production, and that then it's followed by sales. So our drilling timeline is very short. In a real estate project, after the construction of 3-4 years, then you need 1-2 years to stabilize the project because there's really no stable cash flow until 1 or 2 years of the operations. That is why most of these loans are structured for 5-7 years because they need that time to stabilize the project. And the exit strategy is always to go and refinance that EB5 loan. After the asset has stabilized, then you can go to a bank and refinance the loan. Then, of course, there's uncertainty with the refinancing. There's refinancing risk, meaning you better have the market value in that asset, which is what you projected 5-7 years before that. A lot of these projects have a lot of debt. They're borrowing up to 75-80% of the project's costs, whereas we are not repaying from refinancing. We're paying for cash flows. As I discussed earlier, we have a wide margin. At today's prices, we have 100% margin, and our cost to produce is about $32 a barrel. Whereas in real estate, the margins can be quite tight due to the high leverage as well. This is a rural project. It's I-956F approved. The project has approval, which means we also have priority processing and a 20% visa set aside. You may have heard that oil and gas is riskier than real estate. This is simply because this is the real estate dominated market, and the real estate developers, they control the narrative. But the fundamentals that I just discussed with you tell a very different story. So now I'm going to play about a 3-minute video on our process, how we drill and how the process works. And then Mark Wagner is going to take over and make a presentation on some of the technical aspects.
Vertical wells drilled during the 70s, 80s, and 90s only extracted about 3 to 4. Vertical wells drilled during the 70s, 80s, and 90s only extracted about 3 to 5% of total reserves available in their target area. A common misconception is that drilling an oil well taps into a pool of oil. In reality, oil and gas is dispersed throughout various layers of rock and migrate to the most porous areas. These areas are under enormous pressure from the weight of the earth above and dense rock below. By drilling a well, you create a low pressure area, causing the oil and gas to be pushed towards the well. We'll be horizontally fracking previously drilled wells. This begins with drilling a 1.5 kilometer horizontal well from the existing vertical at a depth determined by our geologist. A perforating gun is then inserted. Creating foot-long fissures in the rock formation. Fracking fluid is then pumped into the well at extremely high pressure, cracking the shale rock and creating fractures where trapped oil, gas to escape. Sand and clay is injected to pop open the fissures. Newly fracked wells are initially expected to generate about 300 barrels of oil per day, then decline to about 100 barrels of oil per day by the start of year 2. Our focus is on the Mississippi Line, a geological limestone formation rich in calcium carbonate that was formed through the deposition of organic material. The formation is approximately 100 meters thick and is renowned for its abundant oil and natural gas reserve. By fracking this horizon, we can extract 15 to 30% of the existing oil and gas resources compared to just 3 to 5% of the original vertical well. And utilizing the existing vertical wells reduces costs to just $27 per barrel of oil compared to $35 for newly drilled well. With existing surface equipment already in place, we can start producing oil immediately after completing the fracking process. Due to high oil and gas activity in Oklahoma, existing gas pipelines and oil chains are readily available for transport from our sites. Our success in recompleting vertical oil wells relies on the expertise of our oil and gas team, which includes a geologist, a petroleum engineer, drilling engineer, heavy equipment operators, and field service technicians. Their combined knowledge and skills ensure that we identify the best opportunity and implement effective techniques for unlocking these untapped reserves. Invest in America's energy independence with EB5 Energy.
Okay. Mark, I'm going to let you take it over now.
Thank you, Ruby. It's a pleasure. Well done. It's a pleasure to be able to speak to everyone. I'm going to go ahead and share my screen. I'd like to make a brief presentation and give you some insight into the operations in the field and what our team has done historically and what we plan to do going forward. Rupi mentioned the experience in the presentation. Rupi's the managing partner and founder of EB5 Energy. I'm one of the executives. I have 45 years of oil and gas experience all around the world. I've drilled and operated over 2,000 wells globally. That's actually a small number if you add in the wells in which I've been partner or that I've supported. Dennis Tatum, our CFO, has over 35 years and has worked on over 2,000 wells. Our Vice President of Engineering, Eric Marshall, has worked on tens of thousands of wells. I wasn't able to get a rough number from Eric. Michael Short, our geologist, is a year or so more senior than I am. He's worked on over 5,000 wells. We were speaking today, that number is more like 50,000 wells he's done geology on in Oklahoma and in West Texas, just in those two areas. And then one of our advisors is Eric Cunningham. He has over 40 years of experience. You can see we have a very experienced team. I'd like to give you a little bit of an orientation as to where in the United States the project resides. Obviously, this is the United States. The area of interest for us is a county called Major County. It's located roughly right here in Oklahoma, in this area here. And we'll drill down just a little bit more. This is Oklahoma and all the different counties. Some of the major cities show up here: Stillwater, Oklahoma City, Norman. Our area of expertise in terms of our project is in Major County, as I said before, and it's located roughly right here in Oklahoma. This is a map of the vertical wells in just a portion of Oklahoma. We went back and did a well count. There's over 500,000 vertical wells drilled in Oklahoma historically since the early 1900s. You can see that the dots are generally representing gas and a mixture of oil, and then the green dots represent oil wells. Most of the wells produce both oil and natural gas. We were talking earlier, I want to be clear that when I say gas, if I say gas, natural gas, not gasoline, not the product that you put in your vehicles. So this is a set of wells, just this area right here. We've looked at a large portion of these, represents a couple of things for us. It's a massive well count. It generates an enormous data set for us. Each one of these wells provided geological and reservoir information that's public information. And then we've also pulled some private information through our relationships with local operators to help us set our knowledge and reduce the risks associated with geology and reservoir quality in our area. Let's look at a subset of these. Just in that area, of that total number of wells, there's been over 16,000 horizontal wells. And as the little movie showed you earlier, we're in the business of drilling horizontally, drilling sideways. And so each one of these wells represents, that you see here, a horizontal well, and you can see the small lines. And to be clear, each square here is 36 square miles. So it's 6 miles by 6 miles. Give you an idea of the scope of this activity out here. I think the takeaway, and it's real important to know that in the oil and gas industry, horizontal drilling it represents a revision and a technological step of enormous importance and consequence. It's old enough to be a common activity, and it's new enough to be an improvement over the old vertical wells. On this map on the left side, you can see again Oklahoma. Here's Texas and Kansas here to the north. And the colors here represent the formations in the Anadarko Basin, Anadarko Super Basin, getting deeper as we move to the south and a little bit as we move to the southwest. This is a cross section, which means we've just sliced the earth from here to here. It's a slice looking down in this map. And so our area of focus is right up here. You can see it's shallower than down here. And the wells that are drilled in this area are drilled by the larger operators. And the reason that they like drilling down here is the wells are more productive, but they're significantly more costly. If we go back to this map, these wells down in this area here are drilled by Chevron and ExxonMobil and Devon. And for them to move the needle to produce enough oil and gas to make it worth their while to drill a well, they need 2,000 to 3,000 barrels of oil a day, but they do spend $10 to $20 million on each one of the wells. We picked this area because it's shallower and we can spend $5 million on it. Now we'll produce 300 to 400 barrels of oil a day. And for us, that's a significant amount of oil for the expense associated with that revenue. And so they're playing down in here. Interestingly, however, this area that our group worked on and been working on for over 5 years to really understand the geology in this area. And these two little squares represent the acreage position that we currently have, about 1,300 acres. This area here, we identified 5 years ago as a sweet spot. It's a good spot relative to depth, lower risk of drilling, and good production in the area. And as it turns out, over the last several years, many of these operators are starting to move into the area and compete with us for some of the locations. So we still have a head start. And so we're in a great position to execute our plan. This is a closer view of our area. Each one of these squares is 1 mile, about 1.3 kilometers. So we have 2 positions here and here, each 640 acres for a total of 1,280 acres. That represents enough acreage to drill 8 wells, our initial 8 wells. This is section 8 and this is section 20. Here, I wanted to show you that Canvas Energy, which is a major player in the area, has been drilling wells near us. ExxonMobil is down in here. A company called Mach, which just made $1 billion acquisition of XTO's position out here, is also down in here and moving towards our position here in these 2 sections. This map shows basically the same information, but let me describe these bubbles. The green bubble shows how much oil is produced. It's a cumulative amount of oil production. The larger the bubble, the more oil that's been produced. At the cutoff here, the largest bubbles are 200,000 barrels of oil. The red represents natural gas, up to 2.2 billion cubic feet of natural gas. This is our Schrader acreage right here. You can see the large amount of production. This is an ExxonMobil right here, and this is a Devon. This is Canvas's wells. These are wells that have been drilled in the last 5 or 6 years using very advanced technology, the kind that we're going to use in our wells. So you can see the great production here. And again, keep in mind, this is 1 mile, 2 miles, 3 miles away from us. Okay. So it's very close. It's very proximal to what we're going to do. Every operation, whether it's real estate or whether it's oil and gas, has a risk. We've identified the major contributors to our risk profile, and I'd like to mention here what we've done to mitigate them. As I've talked about already from a geology standpoint, we're drilling where there are wells that are successful nearby. Our wells will be at least as productive as theirs, if not more productive, because we're going to continue to utilize improving technology. Same way with the reservoir quality, and that's identified in the amount of data that I showed you earlier, or at least the well count that represents the amount of data. The drilling costs, we're not drilling that deep. 7,100 feet is actually in the oil and gas industry is a relatively shallow well. And we're using a 1 mile lateral. Some of the larger operators are using 2 and 3 mile laterals. But to keep our risks down, we're going to drill only a 5,000 foot horizontal leg. Our lifting costs are optimized for the flow rates and components. Water disposal is a major component. Our wells will make quite a bit of water initially as they produce. We've negotiated a dedicated contract to a commercial water disposal well in the area, and we're going to lay a pipeline to it. And that's brought our water disposal cost from $2 a barrel, and we'll be producing 1,000 barrels of water on our first day of production, down to 70 cents a barrel. That represents a $1.30 reduction. So that's one of the efforts that we've made in the area to bring our operating costs down. The vendor selection, or our drilling and completion partners, are all experienced in the area. We're not pulling anyone from other areas. And our permitting and regulatory work is actually 100% done. We have 2 APTs in hand now, and we can file for the other 6 at our convenience to drill our first 8 wells. Mention our key partners again. We don't own this equipment. We rent this equipment or we lease it. We have contracts with under negotiation right now with a company called Power Rig. They have 9 rigs working in the area. Stamper Drilling now has 3 rigs working in the area. Very extreme experience levels with both of these companies. The Directional Company, MS Directional, has drilled thousands of wells in the area. And then the Drilling Fluids Company, which provides the drilling fluid for us. Very experienced. These are some key partners that we've established a relationship with and are ready to contract with when we're going to drill. Something that's quite different than real estate investments, and Rupi touched upon it earlier, is how the cash comes out of our investment, how it comes out of a well. This is a net revenue curve. It represents how oil and gas wells produce. So oil and natural gas production is high initially. It declines over time. This well would produce past 2040, but we've truncated it here just to make it easier to see. This is net revenue. That means this is the actual amount of cash that the well generates after expenses. So I just wanted to show you how this works. And Rupi said earlier, early on in these days right here is when We'll get our money back in the first 3 years, 26, 27, 28. So this much production will occur for us to get 100% of our money back. And then the well will continue to generate net revenues over time. This is a bit of a breakdown of the cash. So it will generate almost $12 million of total oil revenue and $2.5 million of natural gas revenue. These are their expenses, which means that it nets up over $6 million of net cash, which is about a 31% internal rate of return and a 2x ROI. I'd like to show you now some field operations, some of the activities that we've been performing as we continue to accumulate capital to drill our first wells. This is a workover rig working on one of the wells out in the field that we were responsible for. One of the gentlemen working up in the derrick, which is the mast. This is a pumping unit on one of our wells, and this is one of our current production facilities here. These are oil and water tanks. This separates the oil and liquids and gas and moves the gas into sales. Meters over here, and this is an oil treater. This separates the oil and water and puts the oil in the oil tanks right here and water in the water tank. As far as frac jobs go, we executed just recently several frac jobs. Here's one happening over in Major County, daytime and nighttime picture. We go through the night. Once we get started, we don't stop these massive hydraulic frac jobs. This is a partial. Each one of these tanks holds 500 barrels of water, and we would line up about 40 or 50 of these to hold roughly 1 million barrels of water for our frac job. And here's the installation of a pumping unit on one of the wells that we've operated. In this case, this needed a crane. It was a large pumping unit. And these are our two sections. These are Google images. So this represents the 4 wells that we would drill in the Schrader well, and we would drill from location roughly right here. On the Weaver section, these are the 4 wells we would drill here. The drilling pad would be here. So all the wells would emanate from here, and they would be drilled in this fashion. So that we drill over and down and then horizontally. The red line represents our saltwater disposal line that we will put in when we're ready to go. This is the commercial saltwater disposal well up here. And this is the pipeline here to our pad. And then this is another one that will run over to our Schrader. And with that, Rupi, I'd like to make just a few more comments, if I could, on the economics relative to the costs associated with this. Is just a tabular projection, and it shows the production along the top and the expenses along the bottom. But the cost of the well at about $4.6 million, there are a number of large tax benefits associated with drilling oil and gas wells. Part of this cost at $4.6 million is what we call intangible drilling costs. And those costs, a large portion of those intangible drilling costs are a deduction. If you have an income that can support deductions, your investment will get its proportionate share of the tax deductions associated with the drilling of the well. Obviously, as I showed you before, there are hard pieces of equipment in the field. Those pieces of equipment get depreciated over time. It's a 5-year depreciation schedule. We'll have about $300,000 worth of equipment on each well. So that'll be depreciated over time. So there'll be a tax runoff associated with that. As well, there's a thing called a depletion allowance. And that means that of the 250,000 barrels of oil that's projected to be produced from each one of our wells, every year as we produce that, the value of our resource drops because we're collecting the revenue. And there's an allowance that's given by the government for that depletion, and that's another tax write-off. There's some significant accretive economic aspects of the tax structure for drilling and producing oil and gas wells. I wanted to mention that and make sure I didn't miss that. And that would be primarily for people who do have income associated with their U.S. position, and they could take it as a write-off. I think a lot of it could be carried forward as well. So if you don't have income now, it can accrue and be available for deductions in the future. And Rupi, with that, I think I'll go ahead and...
Mark, I just want to elaborate on that, the tax deduction. It's one of the benefits of this equity structure. It's only available to investors who are equity holders in the company and are funding the operation. If we had some sort of a debt model, these tax credits would not be available.
That's correct.
I have couple of questions I'll read. So the first one is, what are the chances of drilling into dry wells?
It is nominal. It's less than 10%. And the reason I say it's not zero, nothing's zero. There is a possibility that there's something odd geologically, but there's so much information that we've mapped that we know. We've looked at the rock and the reservoir quality in wells directly around where we're going to drill and actually in that area, in that square mile. So it's very low. We have tremendous knowledge of the rock.
Okay. Okay. Next question. Is this a new technology for horizontal drilling? If yes, do we have a successful implementation for this extraction technique?
It is not new. It's 15 to 20 years old when it was first introduced. There's been hundreds of thousands of wells drilled around the world now using horizontal technology. It's mature. And if we put it in context with the period of time from which oil was first discovered to today, which is in the late 1800s. So in the last 15 years, maybe 20, we've drilled horizontal wells. It has become the dominant way that oil and gas wells are drilled these days. It's almost the only way 90% of the wells are drilled, which is horizontally.
Okay. Another question. Could you please explain the financials a little bit more? When you say the investors or the owners don't have to go through a third party to get their money back, are first in line for repayments, even after 3 years when they receive their principal, they will still receive some income from this investment. Okay. Do you want to
It's
take
something
that
you
on?
should take, Rupi.
Okay. So when you make an investment, you make an investment into the new commercial enterprise, which owns and controls the job creating entity, which owns the oil wells and the production. And the cash flow is earmarked first to get you your money back. We want to preserve your capital. So the first 3 years, we preserve that cash to repay you the $800,000. But as we explained, these wells will produce for 20 years. So you remain a limited partner in the company for the entire lifetime of this company. So even after you get your $800,000 back, you start participating in profits for as long as the wells are produced. Okay, so another one is, do I have to redeploy my money to another project if my case is still pending? Since you mentioned that this energy project will return my investment in 3 years. This is one of the beauties of our project, is that we don't need to redeploy into any other project. If for some reason at the 3-year mark, you have not met your sustainment period, then we just keep your money and we just put it into the next well, which increases production, which increases our revenue. For everybody benefits from it. Compare that to a real estate project where if the funds have to be redeployed, they end up in some other project that you had no say in it, first of all, nor do you benefit from any kind of an upside. All you're getting is risk of another project. How many EB5 positions are available to use and what is the total capacity? So our maximum raise is 120 million, 150 investors. That's what we've been approved for. And this is a very scalable project. So we're starting our first phase with 8 wells and 25 investors. And we will basically continue to drill as we raise capital. This is not like a $100 million project where we have to have all the money raised in order to break ground and start the project. Wells cost about $4.5 million. So we drill 1 well at a time. Currently, we have 4 investors who have filed and 2 have already gotten approved. We have about 6 in progress right now. So we actually expect to complete our raise for the first phase very quickly, simply because of the looming deadline, and we're a very desired project. There's some other question. I'm going to take another question. Have you had situations where the venture failed and the investors didn't get their permanent residency and capital? So I think you're asking about if we have done any prior projects where the venture failed. As far as raising money from EB5, this is our first EB5 project where Mark and the team and we have come together. I've been in the EB5 sector, as I said, for a long time. And we have project approval already, and we also have two investor approvals. So the immigration risk is really, from the project side, is really not there. So I can't say that we've gone through a full cycle yet. Okay. There are some real estate projects offered by regional centers which allow partial investment to start with a commitment to invest in a set period of time. Do you have such accommodation? Yes, we do. And we evaluate those on a case-by-case basis. But yes, we will allow for a partial investment. How long does the investor need to wait for USCIS approval? After the project approval, I would say it's about 6 to 9 months for I-526E approval. So the question about revenue is the investor first in line to receive the revenue or first in line to receive net profits. The investors are first in line to get their capital back. We don't distribute any profits until all of the investors have got their $800,000 back. Only after the investors have received their $800,000 back, then everybody starts participating in profit. Just to clarify, after everyone's got their money back, this is how the profits are split. 30% go to the operators, 35% go to management, and 35% of the profits collectively go to EB5 investors. And that only commences after everyone has been paid back. What is your success rate with I-526E and 829 approvals for investors from India? As I just explained, we have 2 I-526E approvals. We haven't gone through the cycle to get the 829 approvals yet, but one of our investors is from India who got approved. What are the risks to re-enter an existing vertical?
Right. Some of the work that we'll do will be re-entering vertical wells. Some will be brand new wells. I just wanted to be clear that one of our first applications to the USCIS, one of the first project descriptors that we built was to only enter existing wells and sidetrack them. But we modified it because some of the wells that we'd like to drill, there aren't enough wells in the section to drill all 4 horizontal wells from existing wells. Either that or they're not in proper position. Okay. Having said that, we will only drill from existing wells if they meet a couple of criteria. Firstly, they have to be in the right position within the section. Okay. If they're in the middle of the section, it won't work. Secondly, the wellbore condition needs to be suitable. So some of these wells are old. We'll go in and we will assess the condition of the pipe and the wellbore itself to allow for sidetracking. If it doesn't pass those 2 tests, we will drill a brand new well. And the savings is meaningful, but not important to the economics. We would save about $250,000 on it. Now, that's a lot of money. I'm not going to diminish the importance of saving $250,000. But in the context of a successful well, mitigating risks and producing a well that's completely productive in the section, that's a small price to pay. And probably if we drill a new, in some instances, would result in a lower risk and a slightly higher rate of return, even though we have to spend an additional $250,000. Now, that's a long-winded answer, and I know that, but it's important to know that if we don't feel through a technical evaluation, when I say feel, if our opinion, a professional opinion, is that an existing well is not appropriate, either from a risk or a placement standpoint, from which to drill the well, we will not drill from that. We will drill a brand new well.
Okay, one is, do you already have the 10 workers per investor? When it comes to job creation in EB5 and regional center projects, we don't count individual employees for job creation. The job creation is based on the money we spend on our drilling operations, and the economist calculates how many jobs are created. So jobs will be created when we start spending money on our drilling operation, and jobs are also can be counted on the revenue we generate. I want to go back to the real estate project again, in the sense that usually there's 2 inputs that go into calculating jobs. One is, in a construction project, is the construction budget, and the second is usually stabilized revenue. Those are the inputs that are used to calculate jobs. But in a construction project, I would say the revenue jobs are risky because you got to wait many years for those jobs to materialize. But in our case, it takes about 30 days to drill, and then we move into production and revenue by the 3rd month. So both of our job creation on a well by well basis happens very quickly. Mark, you might want to take this. What oil price per barrel is this project feasible?
$40 a barrel, I would say. And when I say feasible, at $40 a barrel, we believe that everyone over some period of time, probably more like 5 or 6 years, would get their money back. At $35 a barrel, we would all get our money back, but it would take longer. We're at $65 a barrel now, and we expect it to be between 60 and 100 over the next 5 years. So that price is tied to our operating costs, and we do everything we can to bring our per barrel operating costs down. My goal, once we get rolling out here and we get some economy of scale and we get some infrastructure built, is to bring our operating costs down significantly below $30 a barrel. My goal is to reach 25. So it's still feasible. And one more thing I think is important to mention, Rupi, is that we will be providing some protection to the downside through hedging. We have a hedging partner that we've been talking to that wants to take our production and hedge it. And so that if oil drops, that we'll be protected on the downside with those barrels of oil, and we'll continue to enjoy a higher price relative to the spot price that might be there at the time.
So one question is, how do we count the 3 years of repayment period? So the 3 years is counted from when we start drilling, because the money has to be deployed into the project. The 2-year sustainment period that the USCIS wants to see is not from the time you invest into the new commercial enterprise. It's from the time it goes into actual operations and starts getting deployed for job creation. So that's how we count the 3 years. So one question is, does the money not have to stay invested through the entire immigration process, which is approximately 5 years? No, that's not the case any longer. With the new rules of the RIA, the new legislation that was introduced in 2022, the government basically said that you have to keep your money invested in the project for 2 years. It's no longer tied to the immigration timeline. What has been major determinants in securing I-526 approvals you received so far? Not sure I really understand the question. The approvals that we received so far, 2 approvals. One did have a request for more evidence on their source of funds, but it was not a problem. They got approved once they submitted the information. What is the number of jobs, direct, indirect, created per investor? Our job estimates are, on the 8 wells, we're raising money from 25 investors, so we need 250 jobs, and we have about 310 jobs we will create for that budget. And on our 72 well program, where we're raising money from 150 investors, we need to create 1,500 jobs, and we have about 2,200 jobs that we'll be creating. So we have a very good cushion on the jobs.
Rupi, there's one there about how many wells are in production. We do have 4 wells in production now. And the way that works is that as we were setting up our position out in the field with the 2 sections of land that I described earlier, each section being 640 acres, 1 square mile, we acquired that position. And in those sections of land were existing wells that were producing. They brought value and they're currently producing. And right now we're averaging somewhere between 10 and 15 barrels of oil a day and about 50,000 standard cubic feet of natural gas a day.
Okay. And last question is, the new gold card, what are the numbers available for that, and does it affect the allocation for EB5? As far as I know, there is really no gold card yet. It hasn't been introduced or legislated, and it does not impact EB5 in any way. Thank you so much for joining us today. And if you have any more questions, please feel free to reach out to me directly. We'd be happy to answer.
Thank you.
Okay, bye.